Okay, beautifully. So, what do we have today? So far, not much, unsurprisingly, obviously. Summer markets, quiet day having to do with data. So far we've had this little recovery in the DXY, right? Not anything spectacular to mention. Lower during the past few hours, but a little bit higher in the day. We've had this breakout, mini breakout in the S&P, right? I was monitoring a little bit this megaphone formation. We broke out of it. We've already reached a few minutes ago the 127% extension of this last pullback at 43.84. So we're now getting really close to the psychological level of 4,400. So, you know, nothing really different there. 4,409, 10 almost actually, is the 161.8% extension of this little pullback. In the case of the Nasdaq, we are lagging a little bit because in essence we tagged the previous high. We haven't really pushed higher yet. If we want to look at the equivalent extension, that would be at 15,107. Okay, now, you know, nothing major here. In any case, you know, intraday webinar, so short-term targets mostly. Now, having to do with the cable, I'm still monitoring this appearing to be descending wedge because we did break above it. We did backtest it earlier today, and you know that very short term makes this some kind of a mini bullish breakout. Although you know I'm keeping my expectations extremely low for the time being because I know that the dollar is mostly being choppy, not a real direction yet. And you know I don't want to jump the gun and say that the rebound higher has finished, has ended, because you know we might find out literally tomorrow that that's not the case. Another pair I'm monitoring is USD yen, and I think it's now at an interesting juncture because we are backtesting this channel trend line support as resistance as we speak, right? So I think that's what I also put as the resistance for the chart of the day. So we are there as we speak. So if the pair wants to turn lower, this is a very good level to do so, although it can also do so a little bit higher. For example, you know, we can extend, I guess, up to 110.80, worst case scenario 111. I don't want to see it above 111. I mean, I have no problem seeing it above 111, but I don't think that above 111 we can be talking about the possibility of seeing more weakness. Probably we're going to new highs from there. Okay. In any case, I do think that this move lower had some short-term impulsive characteristics. So I do tend to believe that we might see more weakness from here. That's the direction I would be looking towards. So anywhere between here and 111, I think we might find resistance and turn lower. You know, of course, for example, CPI data are going to be very important for that because we know that USD yen is very sensitive to yields, right? So one of the two has to happen, meaning either we did find the low over there, right? Either we did find the low over there and we're headed higher in yields, in which case USD yen should resume higher as well, or we're still within some kind of a corrective move in yields, in which case USD yen can turn lower. But both of them can't happen, right? We can't have a breakout in yields to the upside and USD yen correcting lower. I mean, theoretically speaking, we can, but the possibility of something like that happening is extremely low, right? Extremely low. So, you should definitely not count on that. Now, what else has transpired during the day, which, as I said before, frankly, it's not much. We've had a little bit more weakness in cryptocurrencies, but nothing major yet, right? This is a short-term triangle I'm monitoring in the case of Bitcoin. As I said, short-term triangle, right? We're testing support as we speak. So, might mean something if we break through this. Although, admittedly, this flat 30,000 area is clearly a more important area for the market, right? It's also psychological level, rounded number. A lot more people will be watching that than this little triangle that I'm pinpointing to. In any case, this is what I'm looking at when looking at the short-term chart. Ethereum it had a little bit of a better rebound, but in my opinion, looking very heavy, right? We might even make the case that we had a short-term break here, or we're about to have a short-term break here. There you go. So in any case, both cryptos seem, rather heavy. And, I still believe that the path of least resistance remains to the downside. And, the inability of these to jump despite some good news that have come along during the past few days, or anyhow, what the market would have interpreted earlier on as good news, right? Because we know how enthusiastic the cryptocurrency crowd tends to be, is also very, very informative. So in my opinion, not only looking at price action itself, but looking at how this market responds, these markets, or the cryptocurrency market, if you want to look at it as a broad market, responds to news lately. I would have to say that I'm very, very pessimistic that we can have a recovery from here. I think that the markets really want to move at least once more lower to lower lows before we can see a more proper recovery. I don't see the ingredients needed for a proper recovery from here. Okay, so keep that in mind. Anyhow, not very many things I had to say. So go ahead and give me any questions you might have. I'll be more than happy to answer them before we wrap up the webinar. Anyone? I know it's slow. In your view, what will finally derail this crazy rally? Okay. If we're not talking very short term, I mean, what could produce like a short-term sharp reaction lower, which can be literally anything or even nothing. It can just be an emotional reaction, right? So if we want to exclude like whatever can cause like a short-term sake of the weak hands, which in my opinion, as I said, can be anything. If we're talking now a little bit medium to long term, I have a couple of things in mind. One of them is persistent inflation, with the market coming to a realization that the Fed has no willingness of actually doing some catch up with it. So the market still reacts in a Pavlovian way. Every time we get inflationary data, reacts positively for the dollar, believing that higher inflation is going to be met with some kind of action. I think that if the market realizes that there is no willingness for there to be any real action for higher persistent inflation, believe it or not, we might have an event that will lead to a big risk of move. So that's one. A second one, which is completely contrary to what I just said, and would surprise me, seriously surprise me, would be the opposite, for central banks to decide that they actually need to take serious action, which of course is going to be immediately equity negative, right? But I don't think that's there's a real danger for that. I believe that central banks are going to do their best to remain way behind the curve, right? So that's another one. Now, a third one would be a worsening of the COVID situation enough to affect economic activity in combination with not providing equivalent amount of stimulus this time around. Because the market will now expect that if we get some kind of a fourth wave of COVID, there's going to be an equivalent amount of stimulus coming along, and might even initially take it as a positive. Now, if the market realizes, perhaps now, if we combine the two stories, if, let's say, central banks, of course, don't want to be ahead of the curve, which they don't, right? But on the other hand, they start getting really scared that if they provide increasing amount of stimulus, the situation with inflation might completely get out of hand. There is a chance that we're going to see a combination of seeing economic activity contracting significantly, but central banks at least not being willing to give too much stimulus again. That will also be a big shock for the markets, because this time around, there's not going to be this shock absorber type of reaction like, oh, economic activity is contracting seriously, but don't worry. I mean, there is trillions and trillions of easy money coming to plug in the hole, right? So these are the things I would pinpoint as possible dangers for a turn lower in equity markets. Lorraine is asking about the Aussie, and actually it's a good question. Listen, the Aussie, technically speaking, is perfectly positioning for an eventual breakout, right? Because we have this period of time we've already spent within this rectangle, right? I mean, since 17th of June, right? So it's almost a month now. We've been constrained in this very well-defined range. Resistance is at 71 cents. Support is at 69.20. So in between these two levels, there is just noise for my type of trading, right? Now, if you're a very short-term trader, of course, you can take advantage any approach towards support or towards the resistance to trade the other way, right? For my type of trading, anything between 69.20 and 71 cents is noise. We are going to see, though, a breakout eventually, and in my opinion, that's going to be a good trading opportunity, because there is a very good probability that whichever way we break, there's going to be an extension, equal in size with the width of the channel. So in one case, we should be looking towards 67.50. In the other case, we should be looking towards 70 to 75. Right. So that's what I think about the Aussie USD. Now, our friend, mate, since you type all the time and I have to mention your name, I have a question. Where do you tone your name? Is it Amira? Amira? What is it exactly? How do I call you? Which of the two? Amira or Amira? Amira. Okay, good. So Amira is asking about triple D. And then, okay, before we go to that, there is somebody's mentioning the Kiwi. So let's have a, yeah, thank you very much. You see, if you're tired, I was just doing beautiful technical analysis about the Aussie, only little problem being that I was looking at the Kiwi. So forgive me. Yes, so that was the technical analysis for the Kiwi. Having to do with the Aussie, there is a little bit of a different situation here. I'm monitoring this as a little descending wedge. Now, it's not necessarily one, but it's behaving as one for the time being. There's a big difference between the two. And I've explained before, there is a little issue with corrective moves. Corrective moves can start unfolding in one thing and then evolve to something different, right? For the time being, what fits best, this last part of this corrective move, is the descending wedge. Because if we're looking at the whole corrective move lower, then the channel fits better, right? So if we're talking about the bigger move, it seems to be channeled. If we're talking about the shorter term move, oppositely from the Kiwi, which is trapped in a range, we have lower lows here. So a descending wedge seems to fit better. By the way, this little divergence, meaning let's overlay the Kiwi on top of the Aussie. And you'll notice this little divergence, right? So this little divergence. Lower lows here, right? Double bottom in essence there, right? Now, this type of divergence, and to be frank, if you want to take closing prices, which sometimes are important, we actually have a higher high here. You can see it, right, in the Kiwi. This type of divergence makes the descending wedge interpretation even more likely, because many times in turns, very highly correlated markets like the Aussie and the Kiwi can pinpoint the turn by showing divergence in behavior, right? As we see here. In any case, for the bullish case scenario to play out in the Aussie, we need a break above this trendline resistance, right? So the common thing between the Aussie and the Kiwi is that we are also in the middle of nowhere in the short term, right? So Aussie in the middle of this descending wedge at the moment, Kiwi, as we saw before, roughly in the middle of that rectangle. So short term, I wouldn't be doing anything with it, but we break through the rectangle. We're looking for an extension. We break through this wedge, on the other hand. In one case, we're looking for an acceleration lower. In the other case, we break higher. We're looking, technically speaking, for a full retracement of the wedge, meaning a move back to 77.75. Right. So now we talked both about the Aussie and the Kiwi, unintentionally, of course, but we did. Okay. Triple D. Triple D. Let's go to the daily chart to start with. There we go. Okay, so far acting nicely. Although, ideally, for the bullish case scenario, as we drew back here, I would have liked to see this area act as support. But not only it doesn't, but look at today's candlestick is very, very nasty. It's a bearish engulfing, right? Shows a lot of momentum. So we did turn lower almost after reaching a quality target, and we are accelerating lower. We're depreciating lower and accelerating in momentum at the moment, which puts this recovery in doubt, having to do with its nature, right? Especially given the fact that, somebody could look at this whole move as a corrective rebound. And now going back to the conversation we had about corrective moves, in a more complex correction than the one we initially thought, we are within, right? So bottom line, one thing at a time. First, we need to see if this trend line support holds today, right? Second of all, see what kind of a move we get tomorrow. We break through this trend line support and things start looking less rosy by the day, with 2620 being the next downside target. To begin with, I wouldn't be long if we break through this, right? There is even a case to be made that you would want to be short. But let's first see if we hold here. Anything else, guys, gals? Anything else I can answer for you? FVRR. Okay, this seems to be very well behaved, right? We thought we're going to see a little pullback before we continue higher, and we did see a little pullback in what now looks like a very well-defined bull flag. So, yeah, give it a little bit more time. We might need, a little bit more time in here, but as long as we are well behaved within this pullback, I think the general direction clearly remains higher. I also like the fact that we had an overbought reading over here in the RSI. Not a sign you frequently see on a daily chart in a correction, right? So I think so far so good. We might see, this pullback extending a little bit more, but so far it's very well behaved. Wood. Okay, we haven't seen that in quite some time, judging from this. Let's redraw. Let's keep some of the lines. Okay, so. This one here. As long as we trade below 90.60, there is a good case to be made that there is more weakness to come. We break through 90.60, and if you want to be more safe, 92.50, I think there is a very good chance that we've seen the low. So I would remain bearish for the time being, but we're not far away from levels at which I would start, reconsidering. That's what I think about it. Anything else? The Russell. Here it is. Nothing has changed. Bottom line. Above 215, neutral in the short term, in what is more likely than not, a bullish consolidation, right? So an eventual break higher favored. below 215, we then have in hand some type of a complex correction unfolding, and I wouldn't be surprised if we see an acceleration lower if we break through that. But I think that until or unless we do that, you should be looking for bullish scenarios and not bearish ones, right? Having said that, as we speak, we are exactly or almost exactly in the middle of the triangle's range. So bottom line, what would I do with IWM at the moment? The answer is very simple. Absolutely nothing. IWM in the weekly chart. Sure. There it is. IWM in the weekly chart. Okay. That's what I think about it as the most likely scenario to play out. One last push higher as the most likely scenario. One last push higher and then a deep correction lower. Tesla. Likely breaking out. Likely breaking out. Might have even not that the trend line support matters in this case much, right? Might have even already broken out and backtested. There you go. Next area of resistance, 785. Okay, guys and girls, nice having you here once again. I'll see you again tomorrow. Have a wonderful afternoon, evening, depends on where you are. Bye-bye.